In the dead of the night, the world's oil map was redrawn. The US missile attack on the Venezuelan capital of Caracas sent shockwaves rippling through global markets. For years, Venezuela's oil stayed locked underground, choked by sanctions, politics, and decay. Now, in a matter of days, everything has changed. A stunning political collapse in a country with the world's largest crude oil reserves, turning fear of disruption into fear of excess in just a week. Venezuela holds nearly 20% of the world's crude oil reserves, yet it produces just 1.3% of the global supply. Global sanctions and underinvestment have hollowed out production. The narrative is controlled by a country with diplomatic muscle and little oil abundance. The United States holds only the 9th largest reserve globally, but dominates the oil conversation. Even if sanctions are lifted, Venezuelan oil will not flood markets overnight. Recovery takes time, but Washington is already setting the terms.
The plan is for them to spend at least $100 billion to rebuild the capacity and the infrastructure necessary. Venezuela has also agreed that the United States will immediately begin refining and selling up to 50 million barrels of Venezuelan crude oil, which will continue indefinitely.
The timing could not be worse for oil exporters, for whom the spectacle of a shortage due to the Ukraine war has turned into a looming super glut. The International Energy Agency was already warning a glut this year, even before Venezuela happened. Surplus production is likely to hit 3.8 million barrels per day, 65% higher than last year. The supply growth in 2026 is also set to outpace demand by nearly 3 times. Analysts are warning of a super glut in the oil market. They cite major oil projects planned years ago coming online, even as demand slows, especially in China.
We look at what is going to be driving, what is driving the expectations of that super glut. It's hard to see how we don't get there, barring some change to that. What do I mean by that is, given that it's the supply side is being driven by long lead time projects, right? Things that are coming on that have been planned for a decade or more in some cases. That supply is pretty much guaranteed to come on. And demand growth, even if you were to double what people are projecting, you're still not making up for that supply growth. So whether it's a glut or a super glut, it's kind of hard to get away from that.
The super glut and the imbalance in supply and demand puts enormous pressure on prices. Oil prices are already down. Brent crude and Western Texas are both down more than 20% in a year, with natural gas following suit at 18%.
If Venezuelan oil comes back in a big way, then that will displace the Middle Eastern oil, and that will have to go somewhere else. So there's all a kind of shuffling around a barrel. That is perhaps a secondary thing. The more important thing is what pressure does it put on the overall oil price. I don't think a few 100,000 barrels per day of Venezuelan oil make much difference. But if you talk about 1 or 2 million over a period of time, then yes, that definitely means a period of lower oil prices for longer.
Brent crude averaged $69 a barrel in 2025, its lowest since 2020. The US Energy Information Administration expects the price to plunge further to $52 this year. This will be an economic windfall for India. According to IEA, India and China will account to 40% of global oil consumption in 2026, up sharply from 25% in 2025. But India stands to gain more from lower crude prices. India's oil import bill fell 11.3% in the first 8 months of the current fiscal, saving over $12 billion. Lower prices ease pressure on households, businesses, and policymakers. It also makes funds available for social spending and infrastructure schemes. So while a super glut may spell trouble for oil exporters, for India, a nation dependent on imported crude, it could be biggest hidden stimulus of 2026. Bureau Report, Business Today TV.